Okay, good morning, everyone. We are going to get right into the stock market technical analysis charts. If you're new to the channel, we go through technical analysis looking at trade ideas. And that's kind of the key. I try to point out trade ideas when I see them before they actually play out. I give you guys the setups and how I'll be trading a specific setup. And we point those out all the time on the channel. So if you guys find value in that, drop me a thumbs up. I'm going to get right into the analysis. Also, if you're new and you want to learn this skill set, it's not just a watch my videos every day on YouTube kind of thing. You actually can learn this skill set for yourself. Check out my stock market technical analysis course. It's affordably priced for everyone. Link in the description below. And I go through, a couple, it's 4 hours or so of different trading concepts. Really should help you fine-tune your skills. All right, guys, let's get into the charts. We're seeing the thing I want to talk about today is the Fed. We've got the Fed coming out tomorrow. They're going to likely announce a 50 basis point rate hike, and they are then going to do their conference call. So that's pretty much priced into the market, 50 basis points. If you see anything more than that, 75, one percentage point, anything more than 50, then that will spook the market. That's going to say that the Fed is, extra hawkish. The market's going to perceive that as pretty hawkish, and it should sell off. High probability that you're going to see a 50 basis point. This Fed doesn't like to scare the market. And if you see anything less than that, like 25 basis points, then that would be dovish, and the market should rally pretty strongly if you see that. Okay? So keep in mind, that's really the setup. 50 basis points is likely. We're seeing a little bit. If I go to the hourly chart here on triple Qs, the tech sector, yesterday towards the end of the day, pretty impulsive rally. However, it did just rally right up into our resistance level, about 318. We got to go to the daily, back to the daily for that. Yeah, it was about 318, and that's pretty much where it rallied yesterday. Even though it felt pretty impulsive, it just rallied right up to resistance. So we're seeing a lot of pre-Fed chop. It's going to be very choppy and whippy right before the Fed. Today, up slightly, but basically flat. And I suspect we don't really go too, I think they're going to park it basically right on this 318 area coming into the Fed. So keep in mind that, the moves that you see right before the Fed oftentimes are going to be whipsaw signals. Okay, you're not going to have large institutions, large hedge funds taking massive positions right before a Fed meeting. It's just too high of risk. Okay, so there might be some market makers playing games here and retail jumping on, because retail often will take moves before the Fed, but not big institutions. And we want to trade with the institutional money for the most part. They have the amount of money that can move the market. So I think this little move that we saw into the close yesterday and slightly today will be faded. Still looking for more downside. As of right now, we're above our 318 area. But again, it's right before the Fed. It's likely going to be a false breakout to me. So we'll just have to see. Now, again, we do have the bullish divergence. We did just make a divergent low. So I do want to point that out, that we are right here with bullish divergence. There it is. So there is the potential to rally for sure. We definitely have the setup for a rally. If we do rally, I see us probably stopping around this 336 area if we rally after the Fed. So it could go either way, of course. I think we're likely going to break down, run down to our 300 target area, and then probably stabilize, and I think we'll start a rally from down there. But to see it rally right here before the Fed tells me that this is likely going to get faded. IWM, small caps, same setup. You have bullish divergence on the daily. Okay, we made a new low just recently, but it was a divergent low. So, I am going a little bit against the technical analysis because, again, the analysis right now tells me that we're going to rally. The only thing is, we held once, twice right here at this 188, once, twice. We broke. I think we need to at least do a little flush out move, and that's kind of what I'm looking for. We've been kind of stabilized and chopping around in this area. I'm really looking for that flush out move down to my 170 target, which isn't too far below. And again, the rally that we're seeing, this recovery right before the Fed, I don't believe it. All right, I don't take moves that happen right before the Fed very seriously. And that's kind of what we're seeing is, looking at the hourly here, we're seeing a little bit of a rally. If I zeroed in on the 5-minute chart on this, let me kind of zoom in on that. We've got a bearish rising wedge pattern that's building right here on the 5-minute. It should start to break down. And, you have negative divergence on the 5-minute. This is just day trading stuff, but basically bearish rising wedge, negative divergence. You take the widest part of the wedge here, and you take that and measure that from the potential breakdown point, and that's going to set us up for a move down to about 186.50-ish, right in there. So we might close the day right down there around that 186.50. Potentially, and ultimately below this 188. All right, that's the key level that we're really trading around right now is this 188. They're making it look like they're going to recover it today, but again, right before the Fed, I don't know. I'm not going to believe it. So we need to get the Fed out of the way tomorrow. Gold. Okay, so gold did dip down. We didn't quite hit our trend line, but got pretty close. We dipped down to about 1852. The trend line support that I had was about 1840, so about $12 off. Pretty close. Maybe we get there, maybe we don't. Again, this is a big zone of support right in this area. So if there's a lot of buyers that want to buy this thing, then they might step in early. All right. So I've started to build positions in miners. I'm starting to go long. We got out of our miners a couple weeks ago. I'm starting to buy some of those back. Just looking for the most objective ones right now. Okay, oil is basically down today, but the oil refiners are coming out with good earnings. So DVN had earnings yesterday. Obviously, the market liked what they said. They're buying it up. It's objective, though, to short here pretty soon, basically in this area. So DVN, bigger picture, we're getting a back test of the broken trend line. So here's the trend line on the daily chart. You've got support all through here. Okay, we finally broke, so this was your sell signal. We're flagging out. It still is a bear flag, actually. I've kind of adjusted my flag. If I look at the hourly, we still are flagging out, and we're back testing that broken trend line. That big broken trend line on the daily is right up here. So we could run up and hit it. It's about 64.50. That's an objective area to short because we do have a sell signal. Again, you don't want to short when you're selling way down here. You want to short on rallies into resistance or breaks of support. And today we're seeing a rally into resistance. So it's objective to short here for a continuation, but I did have to adjust the flag now. Since I've adjusted my flag a little bit, I have to adjust the breakdown point. So here's the initial breakdown flag. Here's your flag, and you break down, setting us up to a move to about 50-50 now for our target of this bear flag. Okay, so right now, objective to short, again, just a little bit. It could go a little bit higher, up to that 64.50-ish. That would be the most objective area. And I'm looking for that to, basically for this spike here on earnings to be kind of the short-term high. And then I'm looking for them to sell into this strength. All right, so looking for selling to show up here relatively soon. And we start to move lower. Again, that's just kind of part of the earnings game. When you're in a chart, when I'm in a stock, I see more downside, bigger picture, but we got through earnings, they pop it on earnings, and now we got to see if the technicals actually play out. The technicals are telling me we should reject here and go lower. If that doesn't work and they just continue higher and maybe they recover the broken trend line, then we go ahead and stop out. All right. Recovery of the trend line right now is about 64.75, and you're going to want to see not just a little whip above it, but like a pretty impulsive daily close above it. Maybe you close up here at like 65.90. String 2 days of closing above that trend line together, and you're probably going to want to stop out. All right, so that's our stop. We're slightly underwater on the initial entry because here's your sell signal came here on April 21st at 61, and we're down now by about 2-3%. So that's manageable. Again, the way I usually play things is I take profit as we fall, which I did. So as we came down here, I took some profit, took some of the trade off, as we started to rally, I added some of that back, but still haven't added back kind of that full position. So I'm still profitable just because I've managed the trade as we've gone down. But I'm just kind of pointing out the technicals. I think we head lower. This spike, we could go a little higher up into this resistance trend line, but we should get rejected here. This is an objective back test of the broken, of this trend line. Okay, so Apple, this is the one I'm really watching. Apple is kind of the last holdout in terms of the FANG stocks with having any kind of strength, but it does matter because it's the largest stock in the S&P 500 and really in the stock market. So where Apple goes, the market pretty much goes, and Apple's still holding its daily trend line. That's the key. All right, we have this daily trend line here. You can see support all through here. All right, and recently we came down, hit it, and we're holding. Okay, so we need to see this go in order to get that next leg lower in the market. We need to likely see Apple break. Maybe on the Fed, Apple will sell down to the trend line, and that'll be enough for the market to sell down to those key levels, and Apple will still hold trend. But I kind of doubt it. I think Apple's going to break. If we're gonna go lower in the markets, Apple's likely needs to break this trend line. So we need to see that go before anything big happens. Could happen on the Fed announcement. We don't exactly know, but I don't see, that's it. Just watching for that break. That's kind of a major, this is a big chart that I'm really watching and zeroed in on right now. Tesla, again, just battling with this 200-day moving average. You can see we basically have been fighting with it pretty much below it for all week. So you can see we popped above it, closed right at it, popped above it, closed right at it, popping above it. They just keep doing the same thing, but all week just struggling here. So there are definitely sellers here not allowing this to really move higher. Right, so I'm looking for more downside in Tesla. As of right now, we've got kind of a short-term bear flag, which probably sets us up for a move down to about 781.50 on the breakdown. Likely not going to do anything until the Fed. Okay, now I want to spend a little bit of time talking about bonds. So TLT, you're seeing a little bit of a bid today, not super huge or anything, up 1%, but they're buying a little bit of bonds, which is interesting because you're seeing the market rallying a little bit and bonds are rallying as well. That tells me that the rallying in the market is likely retail traders, kind of a fake out move, and then the institutions, which the institutions are the guys who play in the bond market. They're buying bonds, which could signal that they're buying some protection, looking for upside in bonds, as the markets fall, then money might move into the safety play of bonds. Okay, so that's just one thing to look for. One thing I want to note, if you look at the TNX, this kind of measures the 10-year Treasury interest rate. And everything is based off of this. The mortgages, car loans, credit card interest rates, everything's kind of based off of this. If I go to the weekly chart here on the TNX, I can roll way out back to pretty much the entire bull market in bonds, which means interest rates are falling over this period of time. And this is going back to 1981. So my entire life, since I was born, has had falling interest rates, which means my parents basically have rode the wave of stimulus, essentially. Falling interest rates provides multiple expansion, and it just helps the stock market. So pretty much since 1981, the market has had some sort of an interest rate stimulus. And you can see we have this channel that interest rates have been in. All right. So look at where we're at right now, right there. If the Fed allows the market interest rates to rise any more than this, we're going to start to see breakdowns in the system. Each time you've got, this channel, we haven't been able to move outside this channel because the system's built on this channel. The debt load, everything is kind of built on the fact that interest rates are within this channel. So if they break out of this channel and you get a big change in what this means, you're going to start to see big breaks in just financial system across the board. So to me, it tells me that the Fed needs to keep interest rates pretty much capped right here, at least in the short term, cap them here and have interest rates start to come down Okay, well, how do they do that? Well, one way to do it is to get people to move money out of the stock market and into bonds. And that would be, by spooking the market, basically getting the market to sell down, causing people to move into bonds, and something to look for there. Doesn't have to play out, but I can definitely see the Fed trying to say, all right, we need to spook the market down a little bit more to get people to flood into bonds and push interest rates down, because if interest rates go any higher from here, we've got bigger problems. All right? That's really all I have for today. It's pre-Fed, so there's going to be a lot of whippy, choppy action. It shouldn't be, there's really not a lot of trade ideas or key breakdowns or breakouts that I would really trust today. So things to look for. And really, we need to wait and see. We need to get the Fed out of the way tomorrow, and then we should see the next move where the market wants to go. So stay on your toes, because, again, we've got those bullish divergences in the market. We don't have to get those breakdowns going lower where I think the market's going. We might rally. So just stay nimble, and we'll adjust as we get more information. Okay, drop me a thumbs up, guys. I do appreciate it. Catch you on the next video. Bye.